Hey, this is Tom Nash and welcome back to The Value Investor by Tipranks. Today, we're talking about Palantir. Am I fearful or am I greedy? Hang around because this is about to get interesting. Hey, thank you for staying with me. And look, shares of Palantir dropped more than 21% after the Q1 earnings just a couple of days ago. Palantir was not the only company selling off as the entire market took a massive dump on investors' portfolio. But, Warren Buffett famously said, when everybody's fearful, I want to be greedy. And when everybody's greedy, I want to be fearful. And as the fear meter is hitting all new highs, I wonder if this is a time to be greedy. Now, in this video, I'll answer one simple question. How do I deal with the situation? Is now at maximum fear a good time to buy more of Palantir? Now, my bottom line is always ahead of my video, and my bottom line is quite simple. Look, I believe the market completely oversold Palantir's earnings, despite a very good quarter, objectively. And I am buying more shares of Palantir through this dip, and in this video, I'll explain why. Now look, Palantir reported revenue growth of 31% year over year, up to $446 million in the first quarter. And it's actually guiding for a 30% annual growth all the way to 2025. Commercial growth grew 54%. Government was 16%. As government contracts tend to be a little bit later down the year, but it's still growing nicely. Now, what really excited me was the U.S. commercial revenue growth, 136% year over year, and that is with a brand new 2-year-old sales force that has never ever sold enterprise software. I want you to understand this. Selling to governments and agencies is very different than selling to commercial enterprise. And I think Palantir is learning this skill very well. Now, the new salespeople aren't perfect and, they're not very experienced and they will make mistakes. But increase of 136% year over year in the most competitive market, which is the United States enterprise software, is a very impressive achievement. Now, look, the enterprise software market is becoming Palantir's bread and butter, which is exactly what I was looking for. Not to mention the fact that I have $1.2 billion already as remaining obligations, which will be performed throughout the next few years, including a $500 million, which they will perform and bill this year in 2022. Now look, during Q1, Palantir actually added another 40 extra customers, which means the company now has 277 paying customers, which is almost 100% growth year over year from 149 clients just last year. Not to mention that the company maintained a 124% net dollar retention. And having 124% net retention means that existing clients this year are paying 24% more than they paid last year. Now look, even the top 20 clients spend averaged up all the way to $45 million, which is a 24% year-over-year increase. Now, while the top 20 clients still produce $900 million out of the company's total $1.6 billion revenues in the trailing 12 months, which is not ideal for risk management purposes. It obviously has to do with the fact that I have a lot of government business, which is very stable. So the actual risk here is not as big as just a pure enterprise business. Don't forget, half their business is still government. Now look, don't get me wrong. The company is not perfect. And while revenue grew by 31% year over year, the actual cash flow operating expenses grew as well. And despite the annual 3% operating expenses increase on the books, once compensation is actually neutralized, once you remove SBC, the operating margin actually dropped from 34% to 26% year over year, as marketing expenses increased by whopping 40%, G&A, general administrative, by 25%, and R&D kind of remained stable. And look, this is exactly what it takes to create a sales force. I mean, Palantir never had it before 2021. And as the sales force will generate more dollars, this margin will grow. But still, we can't ignore the margins getting smaller and worse. Although I truly believe that this is just a temporary occurrence. Now, another painful point for Palantir is, the stock-based compensation. Which keeps coming down actually. And this quarter, we saw another 25% drop in the amount of stock-based compensation, all the way from $200 to $150 million. But the most important thing was the dilution. In 2019, the company had 600 million shares. In 2020, the company already had 1 billion shares outstanding, mainly due to its choice to go the direct public offering route. The DPO is like that. I mean, the employees are the market makers, and the vast amount of the stock-based compensation that was offered was in those 2 years. But over the past year, the company did not issue any new shares. And from 2021 to 2022, Palantir stayed on just a little under 2 billion shares. I kept telling people that once the DPO was over and once the hiring of a new sales department will be done, the dilution will slow down significantly. Now you're seeing proof of exactly that. Now, the biggest macro story right now is that everybody's switching from growth to value. And of course, Palantir is clearly in the growth sector. So for this reason, and for the reasons I mentioned in this video, I believe the market completely overreacted to the earnings report and undervalues Palantir heavily, allowing me to buy more shares at around $7 per share with a very lucrative 7 times price to sales valuation. Now, of course, if you want to chat with me, if you want to ask me questions, head on over to Tipranks TV. We're going to be there talking to you every single day. The link is going to be below, and I'll see you there in just a few minutes.